Hey everyone, and welcome to another Trade Business Accountants training video. Look, today I want to do something a little bit different. I want to give you guys some behind the scenes access on a recent training session that I actually did with one of our clients. And what I'm doing within this session is providing a really simple process that trade business owners can use to interpret and break down their profit and loss in a way that's going to allow them to make smarter, more informed decisions for their business rather than just making decisions on gut feel. This session will also give you a bit of an insight into how we like to look at the numbers side of things from a profit and loss perspective, and ultimately how we help our clients set financial goals and then work towards them throughout the year. So make sure you stick around, watch the whole video, because I promise you'll have some great takeaways that you can start implementing today. For those who don't know me, my name is Troy Larkham. I'm a client advisor here at Trade Business Accountants, and we work with Australian trade and construction business, typically turning between $1 and $10 million to bank more cash and make more money. And why we're giving away these trainings for free is in the hope that you'll go away with this information, start to implement it, start to make more money, bank more cash in your own business without even paying us a cent, that hopefully you come around the other side and want to use our services to take things to the next level at a much faster pace. So enjoy the video and I'll see you next time. So this will be at the top of your P&L. What we have is gross revenue. So this will be, you can call this sales. I think actually in your, I'll just double check. Yeah, so in your reports, you've just got it sales-plumbing. Sales-plumbing is just gross revenue.
Okay.
So, and again, this is kind of our terminology, but we've got it this way for a reason. So yeah, so this is the total amount of sales come in. This is whatever comes in that way. So from a graphical perspective, it's the full amount. Now, next we have our pass-through costs. Now, I'm not sure if you remember us having that discussion, but this is all the costs related to delivering the job, except it's not including your internal labor. So these are all things that pass from the supplier to the customer. So this will be materials, subcontractors, equipment hire, all those things where, yes, you might be making a margin on it, but it's not a cost that you hold in your business. So if work was to dry up today, these costs wouldn't exist anymore. They're just not there because you're not having to do them. What is there is, your overhead costs as well as your salaries for the field workers.
Yeah.
This is your pass-through costs. So what we'll do, you'll see in your profit and loss, your cost of sales is actually already structured like this largely because you don't have your wages sitting there. So your cost of sales is actually currently a true representation of your pass-through costs. All the costs related to delivering the work, that if I had stopped delivering work, those costs wouldn't be there anymore. They wouldn't exist.
Yeah.
That's going to be your pass-through costs. After our pass-through costs, what we have is net revenue. So obviously before was our gross revenue. This is our net revenue. Now, the reason we've broken these two up, and I'll talk about this a lot more, but so our gross revenue is our total sales, but the reality is our net revenue actually matters more because these pass-through costs, if in terms of comparing the performance of your business, is what matters actually more is net revenue. But construction company, they might have a $10 million business where $9 million is pass-through costs because they might have a ridiculous amount of material, subcontractors and stuff like that. They might have $800,000 in overhead and $200,000 in net profit. Whereas, so their net revenue in that case is actually only $1 million because $9 million worth of their business isn't actually part of their business. It's just from outsourcing and pass-through costs of the jobs themselves. Whereas net revenue, which it'll make more sense as I go into this, net revenue is the engine, what we like to call the engine room of your business. And the reason it's the engine room, because like I'm saying, pass-through costs are all the costs that if the work dried up, you wouldn't pay them anymore. But if work dried up, you have to still fund everything inside net revenue.
Yeah.
So what inside net revenue is your overheads, it's your field workers' salaries, it's any cost that continues to incur even when work stops. It's also what is going to give you your return in pre-tax profit or net profit at the end of the day. And then our net revenue margin is simply the percentage of net revenue of the gross revenue. So a 55%. Within net revenue, the next thing is our field labor costs. So this is going to be our first area we cover. Typically, you would see this sitting in your cost of sales. So some language here. Pass-through costs isn't cost of sales. That's important. Cost of sales does actually include your field labor because field labor is a cost to deliver the work, but field labor isn't a pass-through cost. So to better understand this, from your profit and loss perspective, your cost of sales should actually include your field labor costs. But when we're looking at it from a performance perspective, and this will make more sense once we get into the tool, we want to break it down to have pass-through costs and have our field labor sitting outside of that, because like we've spoken about, field labor is largely going to be the biggest cost in your business, forevermore, doesn't matter how big it is. It's going to be the largest cost. So we want to make sure that we're pulling it out of cost of sales and analyzing it individually. We don't want to bundle it all together with these other pass-through costs because it is such a huge component. So we really want to focus on it. Again, it'll make more sense in a second when we start looking at labor productivity ratios and stuff like that. But coming back from here, so we've got net revenue 550, $260,000 of that 550 is field labor. What we have next, what's left over is gross profit. So for example, when you're pricing a job, if you price it, you quote it up at, let's just go $1 million, for example. It's a huge project. In this job, you're quoting at a 29% margin because when you're thinking about it, the cost to deliver the work are the pass-through costs as well as the field labor costs. So that's how you're quoting it right now. And then obviously we're aiming for the 29% margin. So what you're left with is the gross profit. And what gross profit is the profit used to fund overheads and give you a return in profit. So we go again, gross revenue, then we have pass-through costs. What's left over after pass-through costs is net revenue. Once we factor in field labor from that net revenue, what we're left with is gross profit. So in this case, that's 290,000. So the 29% gross profit margin. In here though, is what we'll also have is management costs. So in this case, I've just got $70,000. So that management salary is technically an overhead because it's covered in the overhead. Because I guess the best way to look at overhead is purely there to be a support basis for you to deliver the work. So if you're delivering no work, overhead shouldn't technically exist. Well, your business wouldn't exist then because there's no need for overhead. Overhead is purely there to support your ability to deliver work. So in this case, your management salaries or your management employees, office employees, admin employees, they all come under that umbrella. They're an overhead because they're not delivering the work, but they're as you grow, especially, they're an essential component to you being able to actually deliver the work. After that, so in this case, similar to what we did with field labor, how we pulled field labor out of cost of sales and distinct them. So this group here of field labor and pass-through costs, this is cost of sales. And then here, overhead and management labor, this is technically overhead. But what we've done here, again, we wanted to break management labor outside of our overhead or operating expenses because likewise, we want to measure the performance and productivity we're getting from our management labor. So then what we're left with here is just the overhead, which is every other overhead expense bar the ones relating to admin salaries and stuff like that. What we're left with at the end then is pre-tax profit. So in this case, we've got $100,000 left over. So your pre-tax profit is essentially, it's your net profit before tax. So a lot of the times in a P&L, I believe it's the same in yours as well. Yep. So in your P&L, you've got net profit at the bottom. From a true accounting terminology sense, it's actually not net profit. It's pre-tax profit. Or in this case, it's actually, because do you have interest sitting in here? So let me double check. No, so this is actually, this is pre-tax profit, what's sitting in your P&L, because your net profit is your profit after tax. So after you've paid your company tax, that's what your net profit is. Your profit and loss, though, doesn't have the capability to show tax payments. Sometimes you can set it up in your zero where you are accounting for some, standard tax figure to give you some sort of indication of how you're performing after tax. It's not really important. As long as you just register that net profit in your P&L is actually pre-tax profit.
Yeah.
So gross revenue, $1 million. We got pass-through cost, $450,000, field labor, $260,000, management labor, $70,000, overhead, $120,000. What we're left with is $100,000 in pre-tax profit, which means we've got a 10% pre-tax profit margin. So like I'm saying, why is net revenue important? Net revenue is your engine room. Net revenue is what covers your pre-tax profit, your non-salary based overhead, your management costs, and your field labor costs. So looking at this number, completely forgetting about pass-through costs, the first figure we need to be looking at when we actually go to the performance tracker is your net revenue. And the reason for that is because if we know how much you're spending in labor, which we know how much you're spending in management salaries, which we know how much you're spending in overhead, or we're predicting how much you're spending, and we know how much we want to achieve in pre-tax profit. So from that, we're going to have an annual target. In this case, was just $550,000. Break that down over 12 months. That might be, $50,000 per month. So that means every single month at a bare minimum, your net revenue has to achieve $50,000. You know, if you're not achieving $50,000, there's a good chance you're not going to achieve your pre-tax profit. Because if this is, let's look at this from a year perspective again, our target here is $550,000. If over the year we only achieve $450,000 in net revenue, well, that means we've lost our pre-tax profit in its entirety, because it's like a tower. If we look at this from a job, if we 10%, not collecting 10% or discounting our jobs by 10% might not seem like much, but the first to go is profit. So 10% in this case would completely erode your pre-tax profit.
Yeah.
So that's why we don't, obviously that's a whole nother discussion about discounting, but in this sense, this gives us a really simple metric to track month on month to go, hey, are we on track? Are we paying our guys? Are we paying our management and office and admin salaries? Are we covering our overheads, and are we achieving our pre-tax profit at the end of the month? And if we can assess that month on month, that'll be really good. Because again, if our target's $50,000 per month, or actually no, let's keep it to this example. Our target here is $550,000 for the year. I honestly couldn't give a shit if you've done that with $600,000 in gross revenue or $10 million in gross revenue. As long as you achieve $550,000 in net revenue, I don't care. Now, obviously, as a profit-driven contractor that we're trying to teach you to become, the less revenue, the better, because that means less headaches, less shit employees. You'll ultimately have less overhead, all those things. So ideally, if you could have $1 million gross revenue and achieving a net revenue of 550, that's all right. That's okay. Because this is based off 29% gross margin. But with that, again, I'm kind of repeating, but I'm just trying to drill in. That's the focus. Net revenue matters way more than gross revenue. If that's the takeaway you have, that's the key one. And then that's why, like I was saying, once we get into the performance tracker, we'll have a monthly target for this each month. And that's the first figure we're going to look at. And the beautiful thing is going to be, there's only two factors that affect net revenue. And that's gross revenue or volume and net revenue margins. So if our net revenue isn't on track, well, the first thing we assess is our net revenue margin. And we go, did we achieve a 55% net revenue margin? Because again, this is 55% of the gross revenue. If we've achieved 55%, we go, oh, great. Our net revenue margin's bang on. We're pricing how we should be pricing. We're performing how we should be performing. Then that tells us that something's going to be wrong with gross revenue. And then we go to gross revenue. And if that's down, then we realize, okay, we've had a volume issue. And then that tells us what do we need to do next month to make sure we get more volume in the door. We're ticking the box of our net revenue margin, which is sweet, but we're not achieving the gross revenue that we need. Likewise, if we look at it and we go, oh, we've only achieved a 40% net revenue margin, but our gross revenue is on track. Well, again, that's telling us we have a net revenue margin issue. So it's either going to be one or the two or both. And it's very easy to figure those out. And each month we'll be looking at that. What we have next is, this should be what is our labor productivity ratio? So this will be something you'll see in a second. Our labor productivity ratio, it tells us for every dollar we spend on our field labor, how much are we getting back in net revenue? So like I've just said, net revenue is the duck's guts. It's the key. It's what we're going to be focusing on. Our labor productivity ratio gives us a really simple metric to know, well, for every dollar we're spending on field labor, how much net revenue are they producing? Because no one else in the business can produce revenue besides your field labor workers. They're the only ones, even though, yes, you're making markup of materials, but unless there's labor involved with that, you can't sell materials. If you're selling just materials, well, then now you're a supplier. You're not a service-based company providing a service. In this case, we've got a field labor cost of $260,000 and net revenue of $550,000. So let's imagine this is our target. Our formula to figure out our labor productivity ratio is simply net revenue divided by field labor cost, which is this case 550 divided by 260K, which equals $2.12. So we know as a target, just in this example, to produce $550,000 in net revenue based off us spending or expecting to spend $260,000 on field labor, we need to produce $2.12 in every dollar we spend on field labor. Now, that might seem like a really random metric, but where it's really, really powerful is before anything, and this is something that we can look into the future. We don't have to necessarily worry about it right now, but it'll become something really powerful for you because you won't have to even look at your P&L. You can literally have a figure weekly of your labor productivity ratio and how it's performed. And if your target, for example, in this case is $2.12, and you're coming in at $1.90, well, then you immediately know something's wrong. Because again, your labor isn't producing the net revenue it needs to produce based off its field labor costs. And because it's not on target, well, we know we're not going to be making the net revenue we need to be making. There's going to be a problem there because the ratio doesn't stack up anymore. So for example, if it's $1.90, immediately we know the issue is one of two things. Well, you know in your head, if that metric's down, you know it's one of two things. Either we haven't achieved our net revenue target, like I was saying just then, or our field labor cost is blown out.
Yeah.
Now, to know whether or not your field labor cost is blown out is really simple, because you can go to your P&L and have a look at it, or you're going to have a understanding of, well, what happened over the past week? Did we, have a lot of overtime and, we didn't get productivity from that? Because typically you want overtime for the purpose of being more productive to create more net revenue. That's what you're doing at the end of the day. But if that overtime wasn't productive, well, that means that's going to have a blowout in your field labor cost in comparison to what your net revenue is. A lot of the times, though, that's not going to be the case, especially in your business right now. Field labor cost will be fairly constant. So again, if our metric isn't on track, that immediately will tell you then at this point, net revenue is the problem. We've got an issue with net revenue. Now, like I said before, okay, we've got a problem with net revenue. What's causing that? It's either volume or it's our net revenue margin.
Yeah.
Like I was saying before. So what we're doing here, I hope you understand, this is kind of like, because, looking at your profit and loss, there's a lot of numbers going on and you can become really overwhelmed with everything. What we've got here now is a process. So before you have to look at anything regarding with your P&L, is if you can calculate, and obviously we'll be doing this on a monthly basis. Don't worry about doing it weekly just yet. We'll do it on a monthly basis. Is we will look at your labor productivity ratio, go, is it on track? If yes, fantastic, thumbs up. How can we improve it moving forward? If it's not on track, then we ask the question, did we have a blowout in field labor cost? Yes, no. If no, then we know, okay, we've got a net revenue problem. Okay, so assessing net revenue, we look at our figure. Yep, we didn't make the net revenue target that we wanted to aim for. Why is that? It's either going to be volume or it's going to be our net revenue margin. One or two things. And then from that, well, if we know it's a volume problem, well, then we know what we need to focus on next month. We need to double down on marketing. We've got to get out there and introduce ourselves to more people. We need to get out there quoting more jobs, trying to build more relationships, trying to strengthen existing ones to get more opportunity. That's all stuff that's going to help volume. If it's a margin problem, well, then we start looking at, are we pricing accurately? Are we not considering the three phases of the job, the pre-delivery, delivery, and post-delivery phases of the job? Are we having blowouts? Should we maybe be back costing to see whether or not, these jobs are actually performing how they should be? Because that's how you start to assess margin. And these will be things we'll get deeper into. But can you see how from this process that there's actually a structured order of events here that's going to make it very easy for you to diagnose firstly, what's going on? And then secondly, how do you fix it? And that's the key. That's what we're trying to do here, is it's understanding what's going on, using these financial statements in a way that's useful for you as the business owner, but not only understanding what they're telling you, how to interpret them to know what your next action is to make sure you improve next month. That's the focus. So from here, we've inputted the target figures from last session. And again, I'll go through this, but you can see here, we've got gross revenue. Net revenue is our engine room. This is the be all end all figure. This is what, again, is covering all those key figures if work stopped.
Yep.
Our net revenue margin of 63%. We got our field labor cost, or our target field labor cost. Here we've got our labor productivity ratio, $1.86.
Okay.
So this is this figure divided by this figure.
Yep.
So if we pull out your figures and you're doing $1.40, what's going on? It's either net revenue or we've had a blowout in labor cost. If our labor cost is good, well, then we look at net revenue. If net revenue's out, we'll know net revenue's off. In that case, is it a volume problem or is it a margin problem? So our labor productivity ratio, that's our number one KPI to measure your performance. Super, super simple and makes it super, super easy. So again, like I said, your focus is to increase net revenue and maintain/decrease field labor cost. Obviously you don't want to decrease field labor cost if it's going to be a negative to you producing net revenue. But if your field labor cost is bloated for some reason, well, then you should look to cut that. Because if we can run our field labor as lean as possible without hindering productivity and net revenue, and then maximize our ability to produce net revenue, that's going to be the sweet spot. And that's when you're going to have a really, really neat labor productivity margin ratio. So obviously right now we saw from before yours was $1.86. Ideally, we want to get you to a position where, you're at a 40% margin, gross margin that is. And with that, you might be at a $2.50 upwards to $3 labor productivity ratio. That's really going to be the sweet spot. And that's typically where we find, the best performing businesses that we work with. That's where we work towards. And once they get to that, that's when they start achieving, 10, 15% pre-tax profit margins. They're really healthy, doing great work. Their field workers are really, really productive and all that kind of stuff. And that's what we'll be working towards. So again, this is the breakdown. Now, simply, so if our net revenue, for example, because if our overhead cost stays the same, our management labor cost stays the same, we have the same cost in field labor, but we perform better and can increase net revenue. Well, immediately that just adds, in this case, we've gone from $550 to $600,000 net revenue. So that's just added an extra $50,000 automatically to your pre-tax profit. So that's why there's a really strong incentive to want to drive your labor productivity higher and higher and higher and higher, because with that, you're going to improve your net revenue, and every dollar extra in net revenue without an increase in cost of all these other areas is going to be $1 extra in pre-tax profit for you as a return.
Yeah.
And that's the focus.